Hey, Ken AG here. I'm going to start today with a sentence that might bother you. You're not saving money. You're trading your life for paper, and the paper is leaking. Not dramatically, not in a way that shows up on your bank statement, but quietly, persistently, in the gap between what your account says and what your account buys. And by the end of this video, I'm going to show you, with nothing but arithmetic and history, how that leak works, how much it's already cost you, and the simplest framework I know for plugging it. No fantasy, no cult, no get-rich-quick promises, just math, and one story from someone I know personally that turned this from theory into something I could never unsee. Stay for that story. It's coming. Quick disclaimer first. This is not investment advice. This is not financial consulting. I'm not telling you to buy, sell, or hold anything. This is education, a way of thinking about preserving purchasing power over time. All right, let's start with the question that separates adults from children in financial markets. And I mean that respectfully because I spent years on the children's side of this question before I figured it out. Most people ask, how much does this cost? That's the child's question, not because it's stupid, but because it only works in one dimension. It works in dollars, and dollars are a measuring stick that changes length every year. The adult question is different. How many hours of my life does this cost? And here's the uncomfortable part. You need to ask that question in two languages, dollars and ounces, because one of them tends to lie and the other tends to expose the lie. Let me give you an example that everyone can feel. In 1965, a gallon of gas cost about 31 cents. And 31 cents in 1965 was roughly 2 silver dimes and a silver penny. Pre-1965 US coinage was 90% silver. Today, a gallon of gas costs around $3.50. Your 31 cents from 1965 doesn't buy a sip. But those 2 silver dimes, the silver content alone is worth about $4.50 at today's melt value. The silver didn't just keep up with gas, it outpaced it. The gas didn't get more expensive, the dollar got smaller, and the silver stayed the same size. That's not an opinion. That's the difference between a measuring stick that shrinks and one that doesn't. Now, most people stop here and say, okay, fine, inflation exists, we all know that. But that response misses the deeper point, because inflation isn't just prices going up. Inflation is your time becoming worth less. You earn a wage. That wage buys a certain amount of life: food, shelter, transportation, education, healthcare. If the currency you're paid in loses 3% of its purchasing power every year, and your wage doesn't increase by exactly 3% or more, then the same hour of your life buys less than it did last year. You didn't get slower. You didn't get lazier. The unit you're paid in got diluted. And over a decade, 3% per year compounds to a 26% loss. Over 20 years, it's 45%. You worked the same hours, you got paid, you saved diligently, and you lost nearly half your purchasing power without a single line item on your bank statement explaining why. That's not a market risk, that's a measurement risk. You're measuring your wealth in a unit that is being deliberately shrunk, and nobody sends you a notice when it happens. Now, here's where most of the financial world stops the conversation. They'll tell you to invest in stocks, bonds, real estate, whatever generates returns above inflation. And that's not wrong. Those are valid strategies. But they all share one characteristic. They depend on the system working. Stocks depend on corporate earnings, market liquidity, and functioning exchanges. Bonds depend on the issuer not defaulting and inflation staying moderate. Real estate depends on credit markets, property rights, and local economies. Every one of those instruments is a promise. And promises work until they don't. There's a reason banks don't keep their reserves entirely in other banks' promises. There's a reason central banks, the institutions that literally create money, hold gold. Because at the foundation of every monetary system, underneath all the promises and all the paper, sits something that isn't a promise, something that just is. Something that doesn't require a counterparty, a court order, or a functioning electrical grid to be worth something. And this is where the phrase, be your own bank, starts to mean something practical. When people hear be your own bank, they picture ideology. They picture preppers in bunkers. They picture some kind of protest against the financial system. But the adult version is much simpler and much more boring. Being your own bank means having a reserve that doesn't depend on the fragility of today's money. A reserve you understand, you control, and that has a track record of surviving monetary regime changes. Not one regime change, multiple, across centuries, across civilizations. Silver has done that. Not because it's magical, because it's physical, it's scarce, and it takes real energy and labor to produce. You can't print it. You can't conjure it with a keystroke. And that constraint, that stubborn physical limitation, is exactly what makes it useful as a savings vehicle, because your savings should be harder to create than the currency you're saving in. Otherwise, you're just holding someone else's dilutable promise and calling it wealth. And here's the part that nobody in traditional finance wants to discuss openly. Saving in currency is a bet that monetary policy will protect you, a bet that real inflation will stay moderate, a bet that your cost of living won't outpace your income, a bet that the rules won't change. And if history has taught us one thing with absolute consistency, it's that the rules always change. Not always because of malice, often because the system needs it. Debts get too large, deficits become unmanageable, political pressure demands stimulus, and the easiest, quietest way to resolve those pressures is to make the currency worth less. No vote required, no announcement necessary. Just a slow, steady dilution that most people don't notice until they try to buy a house and realize the down payment they saved for 10 years now covers half of what it used to. That's why I don't treat "be your own bank" as a slogan. I treat it as an engineering problem. How do you build a personal reserve that absorbs monetary regime changes instead of being destroyed by them? Now, I promised you a story, and this is where the theory becomes real. A close friend of mine, not a wealthy person, not a trader, not someone with inside information, started doing something years ago that everyone around him thought was slightly eccentric. Every month, without fail, he took a small piece of his income and converted it into physical silver. Not a large piece, not a painful piece, just a consistent one. The way someone might contribute to a retirement account. Except his retirement account didn't have a ticker symbol. It had weight. He didn't watch charts. He didn't time the market. Some months silver was up, he bought. Some months silver was down, he bought. He wasn't trying to catch a bottom or ride a wave. He was building what I can only describe as a time vault. He was converting hours of his life into something that couldn't be diluted by a policy decision he had no vote in. And then came the part that changed my perspective permanently. His income got disrupted, not a catastrophe, but real pressure. The kind of pressure that makes people reach for credit cards, sell things at the worst possible time, or make desperate financial decisions they'll regret for years. He didn't do any of that. He did what banks do. He used his reserve to bridge the gap. He sold a portion of his silver at prices that had appreciated since he bought it, not because silver had exploded, but because the currency had weakened. His purchasing power was intact. He crossed the bridge without borrowing, without desperation, without selling a major asset at fire sale prices. Everyone who saw it called it luck. It wasn't luck. It was structure. There was years of boring, unglamorous, automatic discipline that looked pointless during the good times and became invaluable during the hard times. That's what a personal bank looks like. Not a vault full of gold bars in a movie. A drawer, a safe, a stack of coins bought consistently over years that sits quietly until the day you need it to speak. Now let me address the most common objection because I hear it every single day. I'll start when it pulls back. I'll buy when it goes back to a certain price. Right now it's too expensive. That's a speculator trying to dress up as a saver. And there's nothing wrong with speculation. But speculation and saving are different disciplines with different rules. A speculator tries to buy at the perfect price. A saver asks a different question. What percentage of my monthly cash flow can I convert into something durable without hurting my current life? The answer might be 3%. It might be 10%. It might be $50 a month. The number doesn't matter nearly as much as the consistency. Because you're not trying to time a trade. You're building a reserve. And reserves are built through routine, not through timing. Banks don't wait for the perfect interest rate to accept deposits. They accept them every day because the accumulation is the strategy. You should think the same way. Now let me give you a framework, not a rule, a structure, because structure is what survives contact with reality. Layer 1, short-term emergency reserve in currency, cash, checking account, whatever you need for bills, surprises, and daily life. This is not controversial. Everyone needs liquidity they can access immediately. The amount depends on your life, but a common benchmark is 3 to 6 months of expenses. This stays in currency because you might need it tomorrow. Layer 2, purchasing power reserve in metal. This is the layer most people don't have. It's not for next month. It's not for next year. It's for the next decade, the next regime change, the next time the rules get rewritten and your currency buys less. This layer is measured in ounces, not dollars, because the whole point is to hold something whose quantity doesn't change when the monetary unit shifts. When I say silver here, I mean physical silver in your possession or in a fully allocated, segregated storage facility where you have legal title to specific bars or coins, not an ETF, not a futures contract, not a paper claim on someone else's vault, actual metal, because the whole premise of being your own bank is removing counterparty risk. If your silver depends on someone else's solvency, you're not your own bank. You're their depositor. Layer 3, discipline mechanism. Small, predictable, recurring purchases. Monthly, bi-weekly, whatever fits your cash flow. The key word is predictable. You're building a bank. Banks don't grow through one-time heroic deposits. They grow through routine. This approach is called dollar cost averaging in the investment world, and it works for a simple reason. It removes the emotional decision from every purchase. You don't have to decide whether today is a good day to buy. Every purchase day is a purchase day, period. Over time, your average cost smooths out. Some months you buy high, some months you buy low. Your average is somewhere in the middle. And because the long-term trend of silver priced in a diluting currency is upward, your average cost over a decade will almost certainly look favorable compared to where the price ends up. Layer 4. And this might be the most important one. Your metal is not for selling out of anxiety. It's not for selling because you saw a red day on a chart. It's not for cashing out the first time you see a profit. Your metal is for 2 scenarios. First, genuine life necessity. A bridge, an emergency, the moment my friend used his reserve. Second, a rare opportunity that requires real capital and real speed. Because here's what nobody tells you about opportunity. The difference between I wanted to and I actually did is almost always one thing. Liquidity that didn't melt while you were waiting. When a real opportunity appears, a property, a business, a life-changing deal, the person with purchasing power that survived the last 10 years of monetary erosion moves fast. Everyone else watches from the sidelines with a bank account that nominally looks the same as it did a decade ago, but functionally buys 40% less. I see this pattern repeat in every economic cycle. The people who emerge from downturns stronger are not the ones who predicted the downturn. They're the ones who had reserves that held their value through the downturn. Prediction is a game of ego. Preparation is a game of math. And the math favors the person who built a reserve in something durable over the person who kept everything in a currency that was engineered to lose value. And before someone in the comments says, but silver is volatile, yes, it is. Silver can drop 20% in a month. It can spike 30% in a week. That volatility is real and it's uncomfortable. But here's the distinction that matters. Short-term volatility and long-term purchasing power are 2 completely different concepts. Your bank account has 0 short-term volatility. The number never goes down, but its long-term purchasing power bleeds out at 2 to 5% per year, guaranteed by design. Silver has high short-term volatility, but has preserved and often increased purchasing power across every multi-decade period in modern history. So the question is not which one is safer. The question is safer over what time frame. And if your answer is decades, the volatile asset with purchasing power preservation beats the stable asset with guaranteed erosion every time, across every historical period, without exception. Now let me address the historical pattern because this isn't theoretical. In 1971, the United States severed the last connection between the dollar and gold. Before that moment, the dollar was defined in terms of something physical. After that moment, the dollar became a political instrument. Its quantity was no longer constrained by anything except the decisions of a small group of people in Washington. And since 1971, the dollar has lost over 85% of its purchasing power. Not 85% in some exotic hyperinflationary country. In the United States, the reserve currency of the world, your grandparents' dollar bought roughly 7 times more than yours does. Silver in 1971 was about $1.60 per ounce. Today it's above 80. That's not a rally, that's a measurement correction. The silver didn't become 50 times more useful. The dollar became 50 times less useful. And the people who held silver across that transition didn't get rich. They got even. They preserved what they earned. Everyone who held only dollars lost the game without ever knowing they were playing. And this pattern isn't unique to the United States. Argentina, Turkey, Lebanon, Venezuela, Zimbabwe. Every country that has gone through aggressive monetary expansion tells the same story. The people who held currency lost. The people who held tangible assets survived. The only difference between those countries and the developed world is the speed of the erosion. In Argentina, it happens in months. In the United States, it happens across decades. But the physics is the same. Print more units. Each unit buys less. The saver pays the bill. The reason I focus on silver specifically, rather than gold alone, is accessibility. Gold is the ultimate monetary metal. I've covered that extensively on this channel. But gold at current prices requires significant capital per ounce. Silver is accessible. Someone with $80 can buy a physical ounce and start building. That low barrier to entry means the framework I'm describing today isn't just for people with investment portfolios. It's for anyone who earns income and wants to protect a portion of it from dilution. You don't need to be wealthy to start being your own bank. You just need to start. That's the point. The point of building a personal reserve is not to get rich. It's to not get poor slowly. It's to make sure that the hours you worked in 2025 still buy something meaningful in 2035. It's to ensure that time, your most non-renewable resource, doesn't get wasted by a measuring stick that someone else controls. So the question I want to leave you with today isn't about silver prices or market predictions or what the Fed will do next quarter. The question is simpler and more personal than that. Are you saving money or are you saving time? Because if your savings can be diluted by someone else's decision, you're not saving, you're hoping. And hope is a beautiful thing in life, but a terrible strategy in finance. If this framework made something click for you today, hit the like button. It's free, and it pushes this kind of education past the algorithm to reach people who need it. Leave a comment and tell me where you are in the process. Are you just starting? Have you been stacking for years? What's the hardest part for you? I read every comment, and your experience helps shape what we cover next. If you're not subscribed, hit subscribe and turn on the bell. Share this with someone who's still keeping their entire savings in a currency that loses value by design. Not to scare them, to give them a framework. And as always, build that stack. Thanks for being here. I'll see you in the next video.